Welcome to the Climate Talk Invest in Nature in 2025. This climate talk is dedicated around the topic of market trends and risk assessment for nature investments. I'm your host, Alexander from Open Forest. We operate explorer.land. And today we will speak with Michael Grohmann from Callirius. I will quickly give you a little bit of a background what Callirius is doing. So Michael might correct afterwards. Callirius helps investors and also corporates to invest in high-quality nature-based climate and carbon projects. They offer a digital platform with a project portfolio where businesses, but specifically also investors, can finance climate solutions. And the role and the service that Callirius provides is that they increase transparency and quality of these projects with AI approaches, but also really through, let's say, expert screening to select the reliable projects. And with that, they help investors to get access to a high-quality portfolio of projects and help them, investors, but also corporates, to reduce their climate footprint. And by doing that, this, of course, has also a positive impact on the climate, because with these investments, they support biodiversity and also the local community. But before diving into the topic of today's climate talk, I want to warmly welcome my guest and friend, Michael. He is the CEO and co-founder of Callirius, and he is really a nature-based investment expert. So over the past 15 years, I've spoken with many experts in this sectors, but I can say that very few are as knowledgeable as Michael. And as a short introduction of yourself, maybe you can describe how you have pivoted your career from being a full-blood banker to becoming someone who you can meet during a hiking with hiking boots somewhere in the forest in Mexico, visiting a forest carbon project.
Thanks, Alex. Well, full-blood banker, I don't know if it is something good or bad, but it's true, actually. So this is where the career started. So thanks, everybody, for joining in. My name is indeed Michael, and I spent my prior life, like my co-founders, in investment banking. I was mainly in equities, but also did like rate products, was on the buy side, and my co-founders did high yield in portfolio management, asset-backed securities. So we had quite a wide range, but everybody with a banking background. And well, the whole ESG topic, mainly in equities, it was kind of a philanthropic discussions you had with portfolio managers who said like, okay, is now Nestle, is it good or bad? Is it like, they abuse the water, but still they're doing this and that? And it was really just a philanthropic, qualitative question nobody took very serious, to be honest. But it gained traction, and for us it was always a decision by heart to follow nature, even as a banker. And at some point, we questioned ourselves, indeed, still in the bank. So why is there a price on a dead tree? We call it a timber price, which is a commodity at the end of the day, but not for a living tree, which we can measure in CO2. And this brought us finally to the carbon markets, and just to assess it, and saw a lot of problems, especially when it comes to investing, because of lack of data and I think everything we discuss in the future. And this made us leave kind of the golden cage of banking to literally put the boots on the ground and discover the world of carbon markets. And it was a very steep learning curve, because we were just bankers, let's face it, and had to understand projects first before we even got to the point where we say, okay, how to make it investable, and this is the whole story of Callirius. 3 years now in the business. Started in the worst of all times, with Ukraine and everything which came our way, but still enthusiastic and full of power to get something done here and to make it a real asset class, nature, finally.
Yeah, so at the first glance, one might think that finance and nature, this is really there's a strong opposite. So, and maybe they do not really complement each others. But maybe you can give your thoughts or like your view on how or if economy is really depending also on the natural world, on the natural assets, on the ecosystems of today.
Well, yeah, I mean, quite frankly, this is not even a question, right? I mean, you see all the dependency and risk reports and stock listed companies for quite a while now, and we discussed it, right? If you see airlines where they say, okay, you know, when the jet stream changes, they have to change the flight routes and what that means to the whole airline business globally. I mean, this we are talking billions. So when like stainless steel companies tell you that the nickel production would not work anymore on this island where they mine the whole the commodities simply because people cannot live there anymore to do the biodiversity loss, then it's not a question if the world needs it, but it's a given, right? And we see not only after CSRD, but also with the CSRD that there's a high dependency of several
Yeah.
businesses on nature and biodiversity. And this is the business side of things, and then on top comes obviously you know the global view, which we're just living in this one world, and we see that biodiversity, but what biodiversity loss causes, right? It's business related, but also if you see the pandemic lists due to the loss of biodiversity, because some certain things are not digested anymore, and then all of a sudden, we're facing 2000 pandemics in the kind of size and magnitude of Corona, then you see it's like there is no choice. We have to get this fixed, right?
Yeah. I'm sure it was kind of a rhetoric question. So it's quite obvious that the economy really depend on the ecology. So the ecology would do fine with also without economy. But maybe there's a way also to bring these both sides better together. And because my experience, and I think that's also your experience, they don't need to work against each other or let's say exclude each other. So there are ways that it could work together. And I think if we look into the market trends in nature-based investments, we see that more and more investors, corporates really recognize the connection and also the dependencies. And yeah, so my question would be, why should investors direct their focus from a, let's say, pure monetary point of view towards nature-based solutions? And what trends do you see in this area?
Yeah, well, in fact, we see a couple of encouraging trends despite all this, kind of tough times for sustainability, and not only after Trump, but also already before. So first of all, I mean, there was this pollination study out, I think it was like in 2023, where like almost 600 asset managers were asked if they see nature as an asset class, and 71% said yes. And we have more and more discussions with indeed asset managers and institutional investors around nature as an asset class, mostly driven first by carbon, obviously, because it's a measurable unit, which is global standard, whereas biodiversity is not there yet, right? This is definitely where we are. I mean, it's a lot of early stages. We see some, people getting into action like climate asset management, but also Aviva announced a carbon removal fund, Aviva in the UK.
Mhm.
And so this is slowly but surely gaining traction. What we also see, and I mean, Alexander, we both were working on it, is that you see more and more emission trading systems coming up globally, but also carbon taxes and bilateral agreements under ITMOs, under the Article 6 framework of the Paris
Yeah.
Agreement, but also like sector-related approaches like CORSIA, for example, for airlines, or the net positive approach in the UK, where you have kind of a regulatory framework, which also helps investors helps to attract investors because they can act. And an investor, he has a mandate and he can only act in a regulated environment, and the voluntary carbon market says it already. It's voluntary, but if you frame it in a more regulatory aspect, and it does not mean that politics need to set a stage, but I said, these systems coming up and so on and so forth, that helps an investor to gain trust into those systems, and he can finally work with it because he knows, okay, I can use those carbon credits, whatever it is, at the end of the day, in that ecosystem, in that tax system, and then all of a sudden it becomes an investment, right? This is what we see. We see also a lot of companies now under SBTI targets, or Science-Based Target Initiative, for example, seeing when they come out of their reduction phase, right? And this is mostly, to be honest, as of today, it's like pharma companies, it's like tech, software. To be quite frank, people or companies who can afford it these days, right? Whereas, other companies in the industry just struggling with all these high costs and inflation and disrupted supply chains. But those companies now come out and say, okay, I'm going to reach my reduction target under SBTI in 2035 and 2040 and so on and so forth. And now I have to think about compensation, right? And they realize that especially nature-based solution projects, and first of all, you need removal, right? And removal happens 99% in nature and tech solutions. And I include biochar, for example, as a nature-based solution because it includes biomass. And tech-related solutions like direct air capture are not that fast scalable, right? And at a certain price point. So the question is, how do I secure this needed tons of CO2 today for the use of tomorrow? And this picked up big time last year. As said, we are talking about businesses and sectors who can afford it, who have the money today, but others have and will follow.
Yeah, so I think you point out some quite interesting things. So there's a trend in the voluntary market that develops positively. We see on a regulatory level that more states, countries establish emission trading systems. We have also a recent report from JP Morgan that really says that there's a big risk if we ignore nature and do business as usual. So we could have the perception that basically the economy has understand the right direction of this of directing more resources towards nature-based solutions, also to protect economies in the long term and make these synergy more sustainable. But now I have a quite tough question for you. At the moment, while the economy is showing into the right direction, there are a couple of countries, specifically now the Trump administration, that really take, let's say, diametral position toward this. Do you think this is just a temporary thing, or is it really changing the trends, like these positive, global positive trends?
Yeah. So maybe first things first, right? When Trump was first into power, still the driving force behind, or the biggest buyers or purchasers in the voluntary carbon market were US companies, right? Despite being Trump in power. It was Microsoft, it was the JP Morgans, the Shopifys of this world, right? Who made a big portion of the still very niche voluntary carbon market. I also think, the problems with it, or for the voluntary carbon or for nature, started already in 2022, right? So not only for carbon markets, but for any ecosystem service, if you want so. So the war in Ukraine disrupted supply chains. We had geopolitical shifts, higher input prices, and this were the real problems of a company. Because when you talk to any company who is related into production and the supply chain is just interfered or disrupted, then they simply have other problems, right? They have to maintain their business first, because before they can take a stance and say, okay, my climate targets are here, this is relevant for me, but not today, come back next year. On top of that, the voluntary carbon market stumbled over its own mistakes, right? So everything which was written in the Guardian inside about, fraudy Red Plus projects and whatever happened. I mean, to be fair, this was one of the reasons why we started Callirius even. But this was a homemade problem of the voluntary carbon markets. And with that, it basically stopped or just blocked any further development of other ecosystem services and stuff like biodiversity credits and so on and so forth.
Yeah.
Then if you have the European view in it, I mean, especially last year, I can't tell you how often we called a company and talked to them and they say like, you know what, great, I'd like to get involved. Having said that, I'm spending my money now currently on advisors and consultants for the Corporate Sustainability Reporting Directive, the CSRD, which is now in place for 49,000 more companies in Europe since the 1st of January, right? And at the same time, the attractiveness for institutional investors, so this was the corporate side, and for the institutional investors, the market did not really get more attractive. It became less liquid. The size dropped from like 2 billion to 1.5
But you're speaking about the
billion.
voluntary market, right?
Just about the voluntary carbon market, yeah.
Yeah.
And also, how often was talked about Article 6 regulation of the Paris Agreement, that you can, get the ITMOs and Article 6
Maybe you
endorsed.
can quickly explain what Article 6 means to those who might be new to this topic.
Yeah, absolutely. So at the end of the day, Article 6, or everything around Article 6 or international tradable mitigation obligations is just that a host country who produces, let's say, a nature-based project, let's say afforestation, and they generate carbon credits, they give a waiver to the project developer saying, look, project developer, we as a country don't need those carbon credits, or we don't use them against our own climate targets. You can sell them freely to a third country, right?
Yeah.
And then this country can use it to basically compensate for their own carbon footprint. And this is super important because an institutional investor at the end of the day is questioning, okay, again, it's a voluntary thing. So what happens? And we saw this in the past. What happens if overnight in Zimbabwe, and this was a prominent example, obviously, someone wakes up and says, look, all carbon credits out of this project now stay here in Zimbabwe and you invested in it, right?
Yeah.
So, I mean, we know all what this means. And this is just another, security layer you need basically to invest in those projects. Now, summing that up, right? Trump just adds another layer of complexity, short term, if you ask me. But personally, I think it's the best time even to get involved in that market now, simply because we see all these ETS and tax systems coming up, which means that voluntary carbon markets coming under a regulatory framework. CSRD is not only, or a lot of it is done, at least the project phase, but even companies understand now the materiality. And we get the requests now where companies say, look, water is for me relevant. I need a water related business, water protection, water retention with social aspects, and so on and so forth. On top, a lot of those countries now, coming back to Article 6, the biggest biodiversity hubs globally, like Brazil, like Indonesia, like Mexico, understand that nature is indeed an asset, and protecting and restoring it gains and attracts a lot of value rather than only exploiting it, right? And last but not least, well, you can try to deny science, but I think you should not, right? And also there's a short-term setback. I think climate change is still happening, and whoever is president in whatever country, it will not go away.
Yeah. Michael, maybe just a quick question before moving forward. And why is the best time to invest now?
The best time is now, as simple as that, because you see all these institutional investors coming in. You see that nature becomes more regulated, and with regulation, you solve a big problem. Only if it's regulated and kind of standardized, you will attract institutional investors, right? We have like 160 trillion assets under management globally. I mean, if you allocate just a fraction of that towards the nature-based solutions, I think there is a lot of money to make. And the thing is, most of the companies who make use out of these carbon credits, as I mentioned before, now realize, okay, I have my net zero targets in 10, 15 years time, but also realize, given the long lead times in those projects for carbon removals, they have to act rather sooner than later. And then as an investor, you can bridge that gap, basically, which is there because a company not necessarily want or can invest in those projects because they don't have the money, they don't have the credit lines, or don't want to use the credit lines to invest in such a project, but are happy to take off the carbon credits once they are issued. And that kind of time has to be bridged, and this is basically the business for an investor.
And also it's expected that the prices for carbon will go up, so significantly over the next years.
It has to. I mean, let's face it. If the market sits where it is right now and doesn't see any further growth, then markets prices will not go up. But from everything you could see, it is really fair to assume that prices will go up, right?
Yeah. Okay. Yeah, great. So you touched this topic already a little bit. So let's say the different possibilities to invest into climate. But why do you think nature-based solutions and why not tech approaches such as direct air capturing should have a focus at this moment?
Yeah. So first of all, I mean, when it comes to tech solutions, and I'm explicitly mentioning direct air capture here because anything else is for us kind of nature-based or nature-related. So direct air capture is at the moment it's hard to scale. From the technology standpoint, it's I mean, it's a super important technology. Don't get me wrong, it is super important, but it is hard to scale, and even to store the captured carbon, there is not enough spaces out there. So we were talking to a seismic company in Norway, for example, and they say for the next 15 years, there's not enough space even to kind of store the carbon, right? And 15 years is way too long. So we have to act. We have to act now. This is number one. So the scalability comes indeed from nature.
Yeah.
On top of that, there are so many business sectors at risk or face risk through nature: agriculture, food and beverages, pharmaceuticals, insurance, infrastructure, and so on and so forth, that there is a way more interest, not only in the carbon, but the effects of nature and the good doing of nature.
So restoring a forest will also help restore biodiversity, will create local income,
Exactly. So that's
water cycles. So there are a lot of windfall effects basically that come with these nature-based solution projects.
Well, absolutely. I mean, if you believe the WEF, and which says like 55% of global GDP, which is like 58 trillion US dollars of global GDP, is dependent or highly dependent even on nature, right? I mean, this is this is nothing you can make up. So seems to be real, and we see all these pictures in China where people are like try to fertilize apple trees, right? This is due to biodiversity loss. Something like Corona happened due to biodiversity loss, right? And the effects of that and the costs attached to that. I think we all saw that, on what comes on top of that, nature-based solutions, which we find also very attractive from an investor point perspective. Investors' point again is, you get free options because as of now, the carbon is measured in those projects, right? But we see those companies requesting more details, as said, on water, on social engagement, on biodiversity, and so on and so forth. And all these projects with nature-based solutions come on top, which is now called a co-benefit. We expect that to become an own credit or even an own asset class at some time. And we already have those projects where people buy, for example, water retention in cubic meters rather than the CO2. The CO2 is not even relevant anymore, right? And that is a free option in those nature-based solution projects. I mean, some project developers get it. So they put now clauses in their contract saying, look, if there's ever a biodiversity credit, it's mine. You only get the carbon. But mostly it's a free option as of now.
Yeah. Yeah, cool. So then let's maybe put ourselves a little bit into the shoe of an investor. So we know investing or the art of investing is really managing risks in an effective way. So maybe you can guide us a little bit through the approach of Callirius, and yeah, how do you manage risks within these investments in nature-based solutions?
Yeah. So it will be a lengthy answer now, so you better get something to drink.
Prepared.
No, I mean, the key question for an investor, I mean, the key investor concerns, let's put it that way. What is it, right? So number one is market uncertainty. You have the volatility in the carbon credit pricing. You have an over or under supply risk. You have an evolving regulatory frameworks, number one. Then you have an investment risk factors like project failure, non-delivery, lack of accountability, greenwashing concerns, all that. Then there's a liquidity challenge, right? Which is how do I exit that even? How, in a very tiny secondary market, how do I exit that? And last but not least, and this is the core of the discussion, is it is very difficult to accurately estimate the internal rate of return, the IRR, or the return on investment, or both, even the ROI, especially when the only cash flow from those projects is a carbon credit, right? So if you have projects which include, for example, cash flows like biochar, you sell the biochar, you sell the carbon credit, and you sell the heat for electricity production. You have three cash flows, a little bit of a different ballgame. If you have like agroforestry, which involves like timber rights, but also like producing coffee, producing durians or whatever, you have other cash flows, which makes it less risky. And then you have to bridge one problem. So the higher the risk, the higher the return is, from the higher return is asked and required from the investor. And this had a certain limitation because the carbon price, I mean, you can assume that we go to 100 or whatever, but from the level we are now, it is tough. And at the end of the day, the project developer has then the problem, okay, I cannot pay you 25, 30% of IRR, internal rate of return, because then I would have to sell the carbon for like, I don't know, 50, 40, whatsoever. That's not going to work. And this is the core problem. So then the question is how you solve that. And the first step is risk mitigation. And in our world, we have it goes through several stages, and I don't know, just go through it maybe quickly. So first of all, what we do first is we do a due diligence on the project level, right? So it starts with it's a 4-layer process. So we start with a country assessment where we have a tiering of countries and say, okay, tiering 5, for example, are countries on sanction lists where you as an investor simply cannot invest. Tier 4 is, for example, countries who don't have a proper or stable view on carbon markets or high corruption rates and fraud and so on and so forth, where we use certain indicators to assess that. And then you have, this is the country risk assessment. In the next step, we assess the different registries, i.e. the various and gold standards of this world, to make them comparable. And this is something we use where we use the core carbon principles from the Integrity Council of Voluntary Carbon Markets, who give a nice guideline. There's nothing you have to invent yourself. It's a nice guideline where you say, okay, these are the criteria a registry has to fulfill, i.e. grievance policy, conflict of interest policy, is the management capable, how is the financial situation, and so on and so forth. Then we break it down another level to the methodology, right? Say, okay, is there any methodology where it's a reputational but also financial risk for investors? And for example, REDD+ was in the press all over, was everywhere in the press. We excluded REDD+ from our list, not because of the fraud which happened actually, but we never got understood how you can basically sell the carbon from an area which doesn't even is your own, right, without the permit of a government or the local communities. This was, at the end of the day, also the problem. And last but not least, it goes down to a project risk, where we send give you one example. There is gold standard afforestation methodology. It's great. It requires 3 mixed species, but you can plant them in monoculture plots, right?
Mhm.
So we have a and this again it's fine methodology wise, but and it also makes maybe financially sense, but the corporate might have a reputation risk, right? And if he's supposed to be the off-taker or the buyer, then he says like, I better don't do this because someone will blame me for that. So this
Yeah.
is step one. Then we obviously do the on-ground verification, with direct engagement with the project developers, but also with NGOs. And then obviously what we do with you guys, the ongoing monitoring, that we have continuous oversight through satellite imagery, drone monitoring, third-party audits, and so on and so forth. So this is step one. Shall I simply continue?
Yeah, sure. I think it's super interesting for an investor to really understand how to get into that. So you bring all the experience of assessing investment possibilities from, let's say, the conventional financial sector, but I think there are also a lot of learnings that could be applied to investments in the nature-based space.
Yeah, look, at the end of the day, you were asking that question before. Look, it is the same thing. There's a risk reward profile. Any
Yeah,
investor can invest or not. And
yeah,
this is what you have to bring or what you have to align.
yeah,
And this is what we try to do. And, I said it's all about risk mitigation. So the next step then is, especially in a portfolio approach, is simply diversification for stability via a portfolio diversification. And that diversification is basically geographically, right, where we spread over different continents and and to reduce the exposure to one specific region or country,
yeah,
because if there's any regulatory shift, you might have a problem. Then obviously also methodology diversification. Also there to risk management, but also for simply to manage the price point, right? If you only invest into biochar, it's 5 times the price of afforestation. That
yeah,
might not fit also the price point of the investor. Then obviously a stage diversification from very early stage projects where you have basically the highest leverage
yeah,
into very matured, which give you more security but less revenue to balance that. And then also the vintage management, i.e., how all the carbon credits are.
yeah.
Because it's obviously although it does not make too much sense in this market, but all the vintages simply are cheaper, mostly.
Maybe a question regarding the diversification. So are you already considering diversification beyond carbon? So the biodiversity aspect or water aspect, is this also part of this?
Yeah, so this is exactly what we also do. This is the free option I was talking about, where we say, okay, there is a potential of a biodiversity credit because it's in a very biodiverse area like in Mexico, and we see the regulatory framework is coming, which also gives you another uplift in the pricing, either through a second a credit like biodiversity, or as part of a higher valued co-benefit within the carbon price, right? So this is what we assess as well. Yeah, well, and after that, then you have a lot of risk mitigated, but still there is a lot of residual risks, and one is obviously the credit delivery risk. So meaning, okay, I really need this ton of CO2 in 2030. How do I make sure that I really get it? Because the
Yeah,
credits are not issued yet, and there is a risk of fires or anything beyond the buffer pool the methodology already
yeah,
requires, like on Vera.
yeah,
And then we are talking about we're working with insurance companies like Kita and but also Carbon Pool for the insurance against non-delivery, but also political risk. And I mean, this is a very short. It's very short term. It's like you can insure against delivery risk like for 5 years, political risk only 2 years, but it still helps you to get the whole thing started, especially the delivery risk when you're afforestation. After 5 years, forest starts producing carbon credits, and then the whole thing kind of starts evolving, because you know it better than I do with your background. But once a forest is in full swing, it kind of helps itself. Then obviously
Still.
we have the buffer pool allocation, so meaning retaining part of the issued credits beyond the insurance, beyond the buffer pool, which is required by Vera and Gold Standard already. Another layer of security. Then obviously all the monitoring about regulatory risks, right? Where we monitor international carbon regulations and also work with NGOs and the bodies who are responsible for that. And as again, insurance against political risk. And last but not least, the fund liquidity mechanism, so that an investor can choose between cash-based payouts, for example, or even carbon credits. And then you can engage again corporates and investors, because the investor not necessarily wants the carbon credit, but the yield, and the corporate does not want to have the starting investment, which is needed to get those projects started, but is happy to take off the carbon credit with a certain yield for the investor. And well, last but not least, then the question is, okay, we are now in the phase, project started, portfolio set up, we are over this phase, and the question is, okay, what happens when the carbon credits are issued? And there is, for example, an oversupply, undersupply, and so on and so forth. And this is where we, although we run our own platform, we are onboarded with we are regulated ourselves, by the way.
Yeah.
But we are also onboarded with a lot of several brokers, but also regulated platforms like Carbon, CBL, just to have all liquidity pools and to be able to manage those over and under deliveries and over and under allocations. And so that's basically it. And target of all that is just to bring down the IRR needed so that you get investor attracted.
Yeah. Super cool. So, but you explained now all the, let's say, the procedure, the risks. I would propose that we now have a look at the marketplace. So basically, the result that comes out at the end of all these de-risking steps. I'm going to simply share my screen here, and let's have a look at the marketplace. Michael, can you see my screen already?
Yeah, now it popped up.
Now you can see it. Okay, great. So yeah. So what we haven't mentioned yet, that there's already also a collaboration between Callirius and Open Forest. So where we with the explorer.land platform supporting the de-risking and storytelling process. And yeah, we already heard how Callirius is building up their portfolios and selecting the projects and how it all works. But now we want to show how this works hand in hand. So for example, if you are an investor, you can sign up here at the Callirius marketplace. Michael, how many projects do you have currently on this marketplace?
On this marketplace, around 60. So we have a couple of more in the background, so up to 80, which are not in the marketplace simply because of the stage where they are in.
Yeah.
And so this is all we do, right? So it's not like we are not supposed to have the highest quantity of projects, but the highest quality of projects, and this is what we try to have, because you don't, also from investor perspective, you don't need so many projects, because those projects run for 30-40 years. There's scale up options, and new plots they can develop. So why should I, once I've done a decent due diligence, why should I change it all the time? And that's it, right? And for the future, we are not, as I mentioned, with all this regulation, I think banks and stock market brokers, providers and operators will take over the trading part. So for us, it's more the financing, which is interesting, obviously.
Yeah. Yeah. What one can see is that you have projects all over the globe. So from Europe, Switzerland, Mexico, Indonesia, and so on. And as an investor, if you log into the platform, you have the typical search functionalities where you can filter by price, country, project type, and so on. Yeah. So I think that's really beneficial. And you can be sure that these projects have undergone like a quite strong due diligence. I'm just going to open one project so that you get a feeling of how such a profile looks like. So basically, you can directly purchase your carbon credits if you have defined how many you need for your climate or offsetting goals. But it's important that you see, what kind of credits you get, like the vintage, the availability, and also what's super nice is that there's also the prices are really transparent here. So you can compare the prices, but then also see what you get for the prices because while a carbon credit is a carbon credit in the books, in the reality, there are worlds between different type of carbon credits. So you can buy them for €3, you can go up to €50. And in this span, there are huge quality differences and also big difference in terms of the impact that they have on the ground. So we touched this already with the RED project. So here you get like a quite nice profile on what these projects trying to achieve. I picked out here an agroforestry reforestation program in Indonesia. It is Plan Vivo certified. It's, I think, a very diverse and special project because it supports local farmers, help them to create multiple benefit streams so that they can sustain their work in the long term, while the project creates carbon credits, where this initial finance of this agroforestry is conducted. And for all these profiles, you have the certification reports, so a lot of background information you can look at. And all of these projects, they also have like a map-based profile on the one hand for storytelling, but on the other hand also to assess the impact via geospatial capabilities. And I will show you how such a project profile looks.
While you open it, maybe just, why we, I mean, first of all, it all passed our diligence, but especially this project here. First of all, it's Indonesia, where a lot of rubber companies produce caoutchouc, obviously, and rubber, or tire companies produce their rubber. And also, this is community land in Indonesia, and community land, for example, in Indonesia is, as of now, is excluded from any national climate targets. So that makes it as an attractive investment on top of the cash flows they generate through coffee and mangoes and avocados production.
Yeah. Yeah, and such a map-based profile can reveal a lot of information. So you can see where it is, the status when the project has started. You can also check out the certification status. So because some projects also lost their certification status, so there's a link to the registry where you can check it out. And while storytelling is still like I would say, so I think storytelling can play a very important role in those projects. We picked out this project because they have a quite strong story. So they have these agroforestry farmers on the one hand that maintain their own properties while generating carbon credits, and at the same time it's an area. I will show that. Here, so you see it's really adjacent to some closed forest. However, it is located in a very valuable buffer zone for biodiversity. And what they put here inside of the project is they put up wildlife cameras so that they can track animals that are part of this project location. And I always call it a kind of communication jackpot, but because after a week they were able to record a tiger in that project area, which is a very rare keystone species for this ecosystem. Takes a second to load here, so maybe my internet connection is not that good, but you could
Maybe
see
just
the tiger. Yeah.
Sorry, just to elaborate on that, because you mentioned the tiger, right? So as you said, the storytelling is what we try to achieve, and this is why we love exactly this explorer.land geodata management system. Is there are two things. So people have to understand that it's not just an anonymous ton of CO2. Number one, that there's a real people, real project, real everything behind it, but also to tackle simply different buckets within the company. So one is the ESG budget we are tackling, obviously, but this is very limited, whereas marketing normally has a bigger budget at some companies. And with all the storytelling, you can tackle that as easy as that. And the same is HR, not necessarily in Indonesia if you're not producing in Indonesia, but in local projects where people just spend their social day then on those projects. And then you tackle the HR budget as well.
Exactly. Yeah. And as you mentioned, part of it is also the communication for CSR so that organizations also can show how they are involved in these projects. And I think there are a lot of possibilities to better communicate. They work likewise for de-risking, but also for communication. And this is a good example. This is an area where there are agroforestry systems. So you see all the little areas which have farmers that are operating these areas. And with the help of high resolution drone images, you can really see the structures on the ground that they have established to build these agroforestry systems over time. So this is one communication, likewise due diligence tool to see if the investments, the sales of the carbon credits really have activated some impact on the ground. And there are other options like satellite timelines. So we have the possibility to look how an area evolves over time with the help of satellite images. So for the global south, we have the NICFI planet satellite images, which can be used on a monthly basis to see and document the progress within a project area. And yeah, this brings in a lot of transparency. So if you as an investor gave money to do a reforestation, and after 3 years, you could really see the trees growing, this is really evidence-based storytelling that also can be used for de-risking. But basically, it does not stop here with just the visual component. Additional data layers could be used to, for example, check out deforestation in the area. We can see tree global canopy height, so we can really check out how high are the trees in each area. And I'm going to activate another layer, and we'll show it to you in a second. Yeah, so this is an example that shows basically the height of the trees from 1 meter to 24 meters on a 1 meter raster for these project regions. And another data shows also the importance of the project itself. So I'm now activating the biodiversity intactness index, which is basically showing very roughly. So the dark green, there's the biodiversity is very intact. At the gray areas, and the biodiversity is not so intact, or the yellow areas is not so intact. And you see the project is really located at the borders between intact biodiversity areas and more urban areas. So they play functionally also a very important role in the ecosystem. Yeah, I think that's maybe enough for a first dive into what can we do, what can be done with yeah, good due diligence, professional investment preparation, and also with remote sensing tools. Well, so we've spoken now about these platforms. Michael, what are the areas that can be done to scale this towards a higher level? So how can we bring in professional investors, connect them with projects on the ground, and not do it like project by project base, but do you see that there are possibilities to scale this approach and connect it in the long term?
Yeah. Well, yes. I mean, look, at the end of the day, the projects and the whole market has to pivot towards the investor, because the investor is regulated. They have certain mandates. They have certain yield expectations. They have investors in the back. I mean, it could be a pension fund who has to feed the pensioners. It's easy as that, right? And so, in a return on a risk level, our main task is also to help the project and project developers to understand that there is an institutional investor who has a different approach than in corporate, and sees the whole project from a completely different view. And these are the two ends we basically try to bring together. So what does it need? So first of all, I mean, we need some sort of regulation that, again, right, I'm talking a lot of that, and I know that regulation is not very prominent, especially these days. But it's not about that you say, okay, company, you have to. It's more like to give the market a foundation. Like you have the stock market is regulated, the bond market. I mean, it's all regulated. So why should a carbon market not be regulated? And by the way, we had this in the past, right, under the clean development mechanism, and there it was a real bank business because it was a standardized product which was kind of regulated. And all was good. And this is what we are lacking. But this is happening now, as said, not only through the carbon tax and ETS systems or ETS out there, but also through standardization via, let's say, the core carbon principles of the ICVCM, ICROA standards, and so on and so forth, where you get more and more like quality stamps or like CORSIA eligible, and all of a sudden you have like 4 or 5 different stamps on it. It's not yet the super nice, easy to assess market, but we slowly but surely getting there. And one very important element, what we face and where we get the most traction, to be quite honest, is when you connect the investor with the corporate, because it's a very fruitful combination, as they de-risk each other. So as said,
how does that work?
Well, I brought the example before. So you have a company basically who has a net zero target, let's say in 2040, and they know that if they need a certain amount of ton of CO2, they have to start securing those today, given the long lead times, for example, in afforestation and reforestation project, and so on and so forth. At the same time, they maybe not be able or cannot or don't want to put money on the table because they don't want to burden their credit line. They don't have the cash, and it's a heavy upfront investment. And we have that. They say, okay, look, I'm happy to sign a 30-year offtake agreement, right? Then you still can say, okay, what is the credit risk of my the debtor here? Is it good? Is it bad? How can I de-risk that? Do I get more off-takers on board, and so on and so forth. But it's just details. The corporate has an interest in this ton of CO2 because they need it at some point, and they might even face a balance sheet risk because they gave in commitment which was voluntary and risk-free. Nobody took care, but now all of a sudden it becomes a mandatory and an uncovered risk, and this is what they try to and have to avoid. And the investor, on the other hand, he says, like, look, I've no interest, particularly maybe in this carbon credit as such, but I want to achieve some yield. And if you sign the offtake now, I can exactly calculate with a certain risk discount, obviously again, what I get in 10, 5, whatever years, right, from my investor. And that helps obviously a lot.
Yeah, great. So Michael, we're slowly coming to an end, but I'm curious to get your vision or at least your hope on the market, how it might develop within the next 10 years or something like that.
Yeah, again, right, I'm repeating myself now, but we expect the voluntary market to become mandatory in the future. And as said, basically every week we see news flow from other countries implementing an Article 6 framework, i.e. exchanging carbon credits from one country to another, or implementing a emission trading system or a carbon tax system. That only needs not only to a mandatory market, but also to a standardized market, as mentioned before, which is absolutely necessary to have
Yeah.
that framework in place. And only if that happens, and this is what we expect, we can close this funding gap, which is basically needed, or the funding gap, it's like, World Bank thinks it's like $1 trillion each year to be able to achieve the Paris climate target. Well, they say 1.5 degree, but this is obviously outside, but hopefully at least the two degrees target. Well, $1 trillion is a lot of money. Let's face it. Having said that, with 160 trillion US dollars under management globally, it's like we're talking spot 6%, and it's also only spot 6% of global GDP. So, I mean, spot 6% from what is out there to save the world seems a reasonable price, right? So, and this is what
Might,
we
yeah,
would.
could be worth doing it. Should be really worth doing
Yeah,
it. Yeah.
one would think so. But as said, it's not like the investor doesn't want to. He simply cannot very often, simply due to his mandates and regulation he has to face on his side. So
Yeah.
anyway, so if that happens and the market is that standardized, then banks and stock market operators, as said, will probably take over the settlement, the trading, because this is what they do, this is what they're good at. And we also expect that a lot of other assets become an own credit, or at least, a credit or asset class, if whatever. Let's say water, which is even easy to measure, right? Water retention, you put a measurement tool in the soil, then you measure it, and then you can say, okay, I like 500,000 cubic meters of water retention, which I can sell, which already happens.
Yeah.
Biodiversity is much more difficult because biodiversity is local, and we're talking global markets here. So this will be tricky, but this is going to happen. And there's, especially if you look at European companies under CSRD, for example, what they have to report on top of CO2 when it comes to climate change or in relation to climate change. You see this is certainly becoming a own business. So we're literally moving then from carbon to nature, and hopefully nature is an asset class, right? So this is what we expect the market to happen. The question is, how long does it take, right?
Yeah. So we really have to put a lot of power to educate the market because on the one hand, historically, the market is responsible, yeah, for a lot of environmental destruction because the costs of environmental destruction hasn't been internalized. So I think, yeah, there's a big chance, yeah, to solve the climate problems by educating the market and internalizing the environmental costs into this process.
Well, absolutely. And you showed our platform, right? It's a nice, shiny, top-notch platform, no doubt. But having said that, at the end of the day, it's not a market, it's not a platform business even, right? So it's about showing that, it's about educating, showcasing, and that people just get see that it's a tangible asset behind it.
Yeah.
No company will go there and say, I'm now, hitting a button like Amazon, like, and investing now 12 million into a afforestation project in Colombia. It's not going to happen, but it's
Yeah.
about, the touch and feel of that. And this is what we try to achieve and have to achieve at the end
Yeah.
of the day.
Yeah. Thank you, Michael, so much for sharing all your expertise and valuable insights. I think that's really super valuable knowledge, also for investors who look into this new emerging asset class, and which I believe will be one of the most important asset class if we go full-fledged into this asset class to stabilize our climate and also our future. So it was really great speaking with you. I want to thank all the listeners who tuned in today. During the next days, we will also hand out a handout. So with some key facts and information that Michael also shared today. It's a lot, but it has a structure and it's very logical and it's achievable. Yeah, so thank you for joining the Climate Talk, Invest in Nature in 2025 today on the topic of market trends and risk assessment for nature investments. If you are interested in attending more of such topics, you can subscribe to our newsletter. Here in the comments, you will find a link or follow us on LinkedIn. Yeah, have a great day. We look forward to seeing you soon.
Thank you, everybody. I see some questions in the chat. I mean, feel free to reach out to me, and I'll take them up directly.
Thank you very much. Bye bye. Take care.
Bye, guys. Thank you. Bye bye.